Let's get across the market open now. Chris Weston joining us from Pepperstone. Chris, welcome to Tuesday. Great to have you back on the show. Risk off overnight, but I see also very much a focus on what's going on with the Bank of Japan, indicating a possible rate hike, and that did have implications, particularly for US Treasuries.
Yeah, look, I think you've got global bond markets, which are so interconnected these days, and we did see selling pretty much from the outset of the JGB market, and then it was sort of perpetuated by Governor Ueda's speech. Everyone was watching that one very closely because there was a lot of conjecture about trying to understand whether the Bank of Japan would be hiking on the 19th of December. But I think he's pretty much guided to the idea that they're very open to hiking on that date. He used a very, very similar language that we saw from the deputy governor back in January, when just before they hiked rates then. So his choice of wording was very, very specific. And markets have taken that to believe that we're going to see a hike now. The swaps market's now pricing an 86% probability of that happening, up from about 58% the day before, or certainly from Friday. And that sort of boosted short-end rates in JGBs. But I think you've also got to sort of see it with in the sort of comparison or contrast to the new stimulus that's going to be coming from the fiscal plans from the new PM. She sort of detailed this expansive fiscal plans going forward, which will need to be funded by about 11 trillion yen, or 73 billion US dollars over time. And of course, that short-dated issuance that's going to need to be coming through in 2026 will need to be paid for by the private sector. Obviously, that boosts long-end yields. So higher rates, higher rate hike expectations, not just for the December meeting, but also further out the curve as well. If we have a look at the market's implied terminal pricing, which is where the Bank of Japan could take rates over time to the top point, it's pushed up to about 1.42%, and that's getting into sort of the area which we think is probably the fair value of where it should be, around sort of 1.5 to 2%. So that's boosted sort of the short end, 2 to 5 year part of the curve, and then obviously the increased issuance that's expected to pay for this is lifting term premium in the bond market, and that's pushing up back end yields as well. Now that sell-off that we saw in JGBs flowed through to into our market. We just see a little bit of upside in Aussie government bonds yesterday. UK gilts sold off and yields were higher, and then Treasuries were up sort of 5 to 8 basis points across the curve, despite a continued weakening in the ISM manufacturing numbers. So I think the JGB market did sell off. Yields were higher. We've seen 5-year Treasuries, government bonds in Japan breaking out to new highs. They're ripping at the moment, and there's not really a huge amount of buyers coming through in the market. So that's flown through, and obviously, that's kind of put a bit of a handbrake coming through in the risk assets, because of obviously the discounting factor that happens from higher Treasury yields. So I think that's one factor. Obviously, then there has been a bit of a school of thought that the NEC's Kevin Hassett, who's obviously the big front runner to replace Jay Powell next year, and potentially being announced before Christmas. The market's now pricing about a 70-odd% chance that he's going to get the Fed gig. And by all accounts, Donald Trump knows who that person is. He's made it pretty clear. So that could come any moment, really. But this is an idea of a loss of Fed independence coming through. Now, obviously, he's a bit of a dove, wants to cut rates, but he also wants to continue shrinking the balance sheet. And I think he's seen in the market as the candidate who is considered to perpetuate this loss of confidence. He's so close to the president. So there's a school of thought coming through that could have also caused some gyrations in markets last night and increased the selling in Treasury markets. Yeah,
in fact, President Trump has come out to say that he has made his decision. So that's obviously increased that speculation that it would be Kevin Hassett. What are we seeing with the US dollar, perhaps given that speculation, but also more broadly?
Not a lot. I think, if you'd seen Treasury yields up sort of 5 to 8 basis points, and slightly higher US real rates as well, if Treasuries adjusted for expected inflation, you'd expect the dollar to have a bit of a rally. So the fact that we didn't really see too much in the way of dollar selling, is a bit of a messy picture across the G10 space overnight. You'd expect the dollar to be higher based on those higher yields, but at the same time, if this thematic of a loss of Fed independence is truly an issue, then you'd expect the US dollar to go down. So maybe those two factors did offset each other. I guess you have to see, but I think we didn't see there wasn't any kind of major gyrations playing through in the FX markets. It was really, a bond market move, and of course, we can see that there was some pretty heavy selling that took place yesterday across the crypto scene as well. And I think maybe you can articulate that as real rates going up in Japan. The yen was a little bit stronger. It was the best performing currency on the day, so maybe there was some element of yen carry being taken out, and maybe some of that money's been put in the bond in Bitcoin over time. But certainly pretty tight ranges, pretty low net percentage changes on the day in G10 FX, and the dollar didn't really have too much a move based on what we saw with that idea of Fed loss of independence. I guess the other factor is on that side of just loss of independence that could come, a Hassett appointment by Trump. As I say, would be the biggest representation of that thematic. But then you've got Lisa Cook, being her sacking being reviewed by Scotius in January. I think it's the 19th of January, and I think that the market is certainly of the belief that the skew of probabilities here is that she will. That they will uphold Trump's decision, and there's a good chance she will continue to be fired, which again just perpetuates that loss of independence. But I think if we were to see those two culminating forces, it would be a negative for the US dollar, because you have to wear you have to price a higher risk premium into the US dollar in that situation. So it's one that I think really does need to be looked at very closely. I think this loss of Fed of independence is a real concern for the markets. We're not expressing it at the moment, but I think it could be a big theme as we go into 2026.
And Chris, locally, what are traders like to be focused on equity-wise? Looks as though we're going to have start in the green, but not. That's only just, I would have thought.
Yeah, it's just a slightly positive move. We're probably calling the market up 20 basis points or something. Nothing too sinister. Obviously, we're watching to see if we actually get a lot of the news coming through in the wires today. So it'd be nice to see that happen, so we could, everyone gets a level playing field in terms of the news dissemination. But yeah, look, pretty flat moves expected. Hong Kong might have a little bit of an outperformance coming through, but I guess then as the day goes on, we're just going to see again what happens in the bond market. If the JGB market was the central focus yesterday, I guess it will be today as well. And if we see a buyer's strike manifest again, and we see higher yields, specifically in the 5-year part of the JGB curve, I think you could see Japanese equities come under further pressure. I mean, they were down. The Nikkei was down about 1.7, 1.8% yesterday. So if we see high yields playing through, the Nikkei falls, S&P futures fall, and then the ASX will probably come down in sympathy for that as we go through the day. So we'll have to see. I mean, if we do see yields settle down in Japan, maybe that will be a risk-on move, and we can follow on from the goodwill that we saw last week in a lot of these risk assets. But I think it's the JGB market which seems to have really come into the spotlight of the risk markets at the moment.